Good morning. I have come with the next module, Module 12, Set Off and Carry Forward of Losses. So we have learned the basic concepts. We have learned all the heads of income. We have learned aggregation of income or clubbing of income. Now the set off and carry forward of losses. What do you mean by set off? Set off meaning, see, if one head of income, if it is making a loss, income tax act is giving certain provisions to set off that loss against certain profits made in other heads of income. It can be within the same head of income or it can be with another income. Say for example, within the same head of income, meaning if a person is doing two businesses, that meaning business one is making profit, business two is making loss. So this can be adjusted within the same head of income. Another example is against other head of income. See, a person, salaried person. In my case, I am a salaried employee. I am making my self-occupied house property is a loss always. Salary income is a positive value. So here I can adjust my salary positive income with the negative self-occupied income. So my tax liability for salary can be reduced. So that is one income against another head of income. So within the head also it's possible, outside or another with another head of income also it is possible. So we have to remember that income from salary will be always positive value. Similarly, income from other sources also always it will be a positive value. But in the case of house property, it can be a negative value. It can be, in the case of business, it can be a negative value. In the case of capital gain, it can be a negative value. And so these concepts I have explained in this module, and actually in the syllabus. All the universities I checked the syllabus for preparing for the MOOC proposal. Then I found that all the syllabuses it's mentioned, aggregation of and clubbing of income and set off and carry forward, only theory is there. But just to make the concept clear, I have just used one example, one problem I have worked out, just to give you the concept. That is why I have not used many problems, because in your syllabus, only theory will be there. So this theoretical concept will be more clear if I am giving a problem. So that is the idea of giving that problem. Now, meaning of set off. So what is the meaning of set off? Already I have explained that set off meaning adjusting the loss incurred in one head of income within the same head. I have explained with business income or against another head of income. So salary and house property loss, self-occupied house property loss I have explained for that example. So that is the meaning of set off. Again I am explaining what is the meaning of set off. Set off of losses means adjusting the loss against the profit or income of that particular year. So within the year we have 5 heads of income. Some heads of income we will be getting profit, some heads of income we will be getting loss. So how we are going to adjust that? So this adjustment is allowed as per the Income Tax Act. So you can reduce the tax liability. So that is the advantage. Now next point is losses that are not set off against income in the same year can be carried forward to the subsequent years or set off against income of those years. Another advantage beyond this, also income tax provision is allowing the assessee to do that. See, for example, if one year they are not all the possible adjustments they are trying to make, but still they are not able to make certain adjustments, then what they can do, they can carry forward it for next years. One example I will give you, unabsorbed depreciation. Unabsorbed depreciation meaning depreciation provided this year, but business profit and other heads of income, it is not sufficient to adjust the depreciation. So it can be carried forward for any number of years and it can be adjusted with any head of income. So that is the idea of depreciation, unabsorbed depreciation. So that is a beneficial thing for the assessees, especially those who are doing business. Now the third point is a set off could be an intra-head set off or an inter-head set off. So that I have explained, within the same head of income it is possible, or one income against totally different income, that is also possible. Now, there are two types of set off. One is intra or within the head set off. Within the head meaning within the same head of income. I use the business example. Second one is inter or outside head set off. This also I have explained in salary income with the self-occupied house property loss. So that two types of adjustments possible. Now, intra or within the head set off. So this I am going to explain. The losses from one source of income can be set off against income from another source under the same head of income. The same business example I am going to use. See, one person is doing two businesses. One is business A and one is business B. So business A he is making profit and business B he is making loss. So what he will do? The net figure for the result, net income for the business will be adjusting the profit made from one business A and adjust that with the loss made from business B. So that is the within the head of income, within the business head it is adjusted. So that is the second point. Loss from business can be set off against profit from business B, where business A is one source and business B is another source, and the common head of income is business. So this provision is explained in section 70. Now, there are certain exceptions. Always this adjustment is not possible within the same head of income. So, exceptions are, if it's long-term capital gain, adjustment is possible only with long-term capital gain. Whereas, if it is short-term capital gain and long-term capital gain can be adjusted. So, this is the adjustment regarding within the same head of income if it is capital gain. LTCG, if it's long-term capital gain, it can be adjusted only against long-term capital gain. Whereas if it is short-term capital gain, it can be adjusted against short-term capital gain and long-term capital gain. Now, speculation loss. We are coming to the business income. Speculation loss only against speculation profit. It cannot be adjusted with non-speculation profit. So, that is the second point. Speculation loss cannot be adjusted with non-speculation profit. Otherwise, everybody will say that they made loss in the non-speculation business. So, that is why speculation loss can be adjusted only against speculation profit. Now, race horses also only against income from race horses can be adjusted. It cannot be adjusted with any other head of income. Now, inter or outside head set off. That meaning one head of income against another head of income. We have 5 heads of income. So, salary against house property, like that other adjustments I am going to tell you. So, after the intra-head adjustment, within the same head of income, if adjustments are not possible, then the taxpayers can set off remaining losses against income from other heads. So, one head can be adjusted with a totally different head of income. So, loss from house property can be set off against salary or any other head of income. So, loss from house property, either we can set off against salary or any other head of income. Any other head of income. So that is the second point. Third point is business loss other than speculative business can be set off against any head of income except income from salary. So other than salary, business loss can be set off against. It is not allowed for speculative business. Non-speculative business, it can be adjusted with any other head of income except salary. And this is explained in section 71 of the Income Tax Act. Now, exceptions to this rule. When an income is adjusted against totally different head of income adjustments, speculation loss cannot be adjusted with any other income. So this, if this provision is not there, everybody will claim that we made speculation loss. So speculation loss cannot be adjusted with any other head of income. Now casual losses cannot be adjusted with any other income. Now house property only against income from other heads up to rupees 2 lakh. Why 2 lakh is self-occupied house property loss is restricted to 2 lakh. So beyond that you cannot adjust. Otherwise people will pay more housing loan and they will claim that, see my case, I am paying housing loan. I am getting self-occupied house property as a loss. So if I am eligible to make payment, house property loss I can adjust for 20 lakhs. What I will do? I will pay extra housing loan and I'll make my loss equal to 20 lakhs. Then I can adjust with my salary income. So in effect, I will not be paying any tax to the government. That is why this cutoff is there only up to 2 lakh. Now loss from business or profession not against salaries. It is not possible because otherwise all the salaried employees will claim that we are running a business or profession and it's ending at a loss. So loss from business or profession cannot be adjusted against salaries. Now LTCG, long-term capital gain only against long-term capital gain. If it is short-term capital gain, it can be against long-term capital gain or short-term capital gain. Now carry forward of losses. This is the next concept. I have explained that See, within the same year, they will see that whether within the same head of income, it is possible to adjust, or it can be adjusted with one head of income against totally different head of income. If that is also not possible, beyond this certain provisions are there in the Income Tax Act. That meaning they can carry forward these losses for the succeeding, that meaning for the coming previous years, and they can adjust these losses with some heads of income that we are going to see now. So set off of losses means adjusting the losses against the profit or income of that particular year. So that we have seen that how a loss can be adjusted within the same year, within the same head of income or with another head of income, that we understood now. Now losses that are not set off against income in the same year can be carried forward to the subsequent years or set off against income of those years. In the coming years, whatever loss you are not able to adjust in this year, you can carry forward and you can adjust in the future years. Now, losses that can be adjusted. Which are the losses that can be adjusted? Loss under income from house property. Then loss under profits and gains of business or profession. Then loss under head capital gains. Then loss under the head activity of owning and maintaining race horses. Now, the limit also is there. Time limit for carry forward and set off. This is important for examination. See, last module when I told you clubbing and aggregation of income is important for theory questions. Similarly, the carry forward and set off of losses, that is also very important from the point of view of examination. Always I have seen that either in section B or section C, these questions will be there. So I have compared in the form of table because you have to present it in the form of table only. And one more thing I want to tell you, for my explanation, I have used only few words in the PPT. I cannot give full sentences because then the PPT will become very crowded. So when you are writing in the examination, when you are writing the answers, you have to convert it into full sentences and you have to write. So please remember that. So now time limit is there. If it's house property, we have seen that house property loss can be carried forward. So it can be carried forward for 8 succeeding previous years, 8 future previous years. Then that can be adjusted only against house property income. Only against, if you have house property income, you can adjust with for next 8 years. Second is business loss from non-speculation business. Speculation business is different, that they will not allow any adjustments. Casual losses also we have seen that they will allow only against casual income. Whereas non-speculation business, adjustment is possible, cannot be set off under salaries. So this point we have already explained. With the salary, because that is a permanent source of tax collection for the government. They will not allow, only self-occupied house property is allowed. Second one is can be carried forward for 8 succeeding previous years. So 8 future years they can carry forward this loss and against speculation and non-speculation business income. So business, either speculation business, either speculation profit or non-speculation profit, they can adjust this. Next is loss from discontinued business can also be carried forward. So if you're discontinuing, so now this lockdown period, many businesses they closed down. So even if it's a discontinued business unit, it can be carried forward and adjusted later. Now, continuing, speculation loss, it can be adjusted only against speculation gain. Now, the time limit is also different. It can be carried forward only for 4 succeeding future years. That means only 4 previous years they can carry forward that. Short-term capital gain can be carried forward for 8 succeeding previous years. 8 years. Set off against, it can be set off against short-term capital gain or long-term capital gain. Now, long-term capital gain, you have to remember, this condition is different. Only against long-term capital gain only can be adjusted. But it can be carried forward for 8 succeeding previous years. So, when you are preparing it in the form of a table, it's very clear. The concepts are very clear. That is the advantage of presenting in the form of a table. Sometimes I'll see in the question paper, when an answer sheet, like a theory, like an essay they are writing, we cannot make any distinction between these points. So whatever you are writing, make it very crisp and clear so that nobody can reduce the marks. You can score full marks. Now the last head of income, expenses incurred on maintaining race horses. So set off only against income from race horses. Now carried forward for 4 succeeding previous years. So speculation loss and race horses, it can be carried forward only for 4 years. Now, this is always a 2-mark question. Adjustment for unabsorbed depreciation. That is why I have included this. Depreciation which remains unadjusted as either there is no income or less income in the relevant previous year. I told you this is beneficial for the people who are doing business. They have to provide depreciation for all the assets they are using. And if they are not able to adjust the depreciation with the business income they earned, they can carry forward for any number of years. See, the previous slide we have seen that some are restricted to 8 years, some are restricted to 4 years. Whereas in this condition, there is nothing like that, any number of years. And it can be carried forward till it is adjusted from any income during the succeeding previous years. There is no restriction regarding only this income only can be adjusted with unabsorbed depreciation. It can be any head of income. So this is very good for the SSC. Now treated as depreciation of the previous year. So if a depreciation is not possible to be adjusted, then it is called unabsorbed depreciation. It can be carried forward for any number of years. It can be adjusted with any head of income. So when they are adjusting with the next previous year, then it will be considered as depreciation of that year. So this is the treatment regarding unabsorbed depreciation. It's important for 2 marks. Now one problem I told you in the syllabus, it's clearly mentioned that problems are not there. But still for the explanation, to make it more clear, I am explaining this, how this adjustment is possible. Compute gross total income from the following particulars given below. So that is head of income and amount. House property, loss from self-occupied house property is 30,000. Income from let out house property is 16,000. So within the same head it is possible. Now we can adjust, I will explain that. Now one is profit, one is loss. So the total profit will be, total loss will be 14,000 from the house property. Profit and gains, business loss is there 1,50,000. Share of loss from partnership firm. Partnership firm loss cannot be adjusted with the individual business. Partnership firm adjustment is different. Now capital gain, long-term capital gain is there, short-term capital gain is there. So how we are going to adjust this? I have explained in the next slide. Table showing the computation of gross total income for the assessment year 2021, 2020-21. That's a typing error, 2020-21. So let out house property income is 16,000. Loss from self-occupied house property is 30,000. So within the house property income, we can adjust that. So that is within the same head of income we are adjusting. Now the loss is reduced to 14,000 in the case of house property. Now business loss is 1,50,000. The other share of loss is partnership loss. Partnership loss and individual business loss cannot be adjusted. So the business loss will continue as 1,50,000 itself. Now long-term capital gain is 4 lakh and short-term capital gain is 2,40,000. So short-term capital loss can be adjusted with either with long-term or short-term capital gain. So in this case, long-term capital gain will come to 1,60,000. It's reduced. Now this can be adjusted with house property income and business income. So business income and house property loss is 1,64,000. It can be adjusted with long-term capital gain. So 1,60,000. So the loss again they can carry forward for next year is 4,000. 1,64,000 loss and 1,60,000 profit. So the loss to be carried forward for next year will be 4,000. That is from the business or house. I'll explain that. So share of loss from business cannot be adjusted with share of loss from partnership. That I've already told you. Partnership, different set of adjustments are there. Now loss under the head house property and business can be set off against long-term capital gains. So here in this case, after adjusting within the same head of income, house property loss is reduced to 14,000. Business, it cannot be adjusted with partnership loss. So the business loss is continuing as 1,50,000. Long-term capital gain, after adjusting from the same head of income, the profit is reduced to 1,60,000. So 14,000 house property we have adjusted and business loss 4,000 will be remaining. So that we are carrying forward, that can be adjusted in the future years. Balance of business loss is allowed to be carried forward. So I hope this concept is very clear to you. And I told you module 11 and module 12, it's important for the theory questions. Problem papers are not there because most of the syllabus I have checked, it's mentioned that only theoretical concepts. But to make it clear, I have used one problem. So the concepts will be clear to you. What is inter-source, what is intra-source, how it is carried forward, how it is set off within the same year. and if it is not adjusted in the same year, how it is carried forward to the next year. So this is the idea of showing this module, and please remember this is important for theoretical question, section B or section C. Same as module 11 also I told you, clubbing and aggregation of income. Always you can expect theory question. And unabsorbed depreciation is important for 2 marks. Similarly, I told you minors, exemption for minors income. That is important for 2 marks. So certain points I told you, and the same questions you can expect in the examination. How I am able to tell you is my experience for teaching so many years, the same subject. And our students are very smart students. So what they will challenge the teachers. So that type of students we need. Then only we will also become experts in the subject. So going to the class is a tension every day. What all they will ask, and most of the students are doing CA, ICWA, very high academic background. So it's a challenge teaching our students every day. So that is how we have also got an opportunity to learn and grow with them. So that is the advantage of teaching, and I hope that my other students from all over India, because this subject is taught in all universities, undergraduate level also it's compulsory, postgraduate level also it's compulsory. So I will benefit, it will benefit all the students across the country. And please, those who are happy, please subscribe to my channel Ace Commerce with Dr. Alice Vani. I told you I'm going to upload more subjects, so that will be helpful for you in this lockdown period, and when we are changing from face to face teaching to online teaching. So wishing you all the best, and we will see with the next module. Next module, I am going to explain the computation of income and the deductions from the gross total income. So next will be the deductions what we are going to teach. I am going to explain that. After that, the tax liability computation, then this subject will be completed. So that is the syllabus for 2 semesters across the country. So this much only we can learn in 2 semesters, because this is a new subject for the students. So that is what I want to explain today. Thank you for watching, and subscribe to the Ace Commerce with Dr. Alice Vani. Thank you.